Hey, what's up everyone? This is Silver Slayer. And yes, if you noticed, I said Silver Slayer, not Gold Slayer. There's a pretty good reason for that. But that doesn't mean gold isn't a good investment. Silver just has more potential and opportunity. Why? Well, let's find out. So before we jump into this article, make sure you're subscribed. I post daily videos. I'm also giving away over $1,000 worth of silver once I hit 40,000 subscribers. So today we're going to compare silver to gold. And there's a very important tool to determine which is the better investment. It's the gold to silver ratio. That's what we always go by to determine whether we should be stacking or buying silver or gold. Now, what it means is it shows the ratio of how much silver it takes to equal or amount to 1 ounce of gold. Now, here is what it currently is. It's 72 to 1. So it takes 72 ounces of silver to equal 1 ounce of gold. Now, that's a great indicator because when the ratio is higher, that means that gold is more expensive, the better buy, more profitable. When the ratio is lower, that means silver is. And we saw it as high as 125 to 1 in March. That was the cheapest. That was the most undervalued silver has ever been compared to gold throughout the 5,000 years, the entire history of precious metals. So it corrected back downwards, meaning silver started outperforming gold drastically. Silver has been outperforming gold for the last basically year. It went from 125 to 72, which means silver has gained a higher percentage than gold has. And silver was actually the #1 performing asset of 2020. Comparing it to stocks, commodities, equities, everything. Silver came out on top. I made a video about that, I think, yesterday. So here's a special report. What the gold to silver ratio is telling us. The current technical structure suggests that the ratio may be headed lower. Now, if the ratio is headed lower, that means that silver is going to rise even higher than it already has. Now, silver is a more volatile metal, meaning it hits higher highs and lower lows. I always like to call it gold on steroids. It's a more extreme, more exaggerated form of gold. So there's a lot more potential and opportunity, but there's a lot more risk. Now, I don't see the risk being that big of a player to really decide or weigh out when you're determining, because precious metals, they're not risky at all, in my opinion. Anyways, you're putting value into value, or fake value, fiat money, into something that holds its value. So the risk factor isn't really relevant. So This is what we're gonna dive into. This is gonna be a great article because at the end we can also talk about some of the benefits of gold compared to silver, because there is some, right? There's some things that you might get with gold that you can't get from silver, but I'm also going to talk about why silver has a lot of room to run, especially looking forwards, where gold doesn't. So the gold to silver ratio is much watched indicator in the precious metals markets and is often traded as an entity in its own right. In this brief study, we look at a series of periods in which the ratio has changed sharply, as well as the longer, shallower periods in between. And I know a pretty good amount about the history of the gold to silver ratio. I can date back to biblical Egyptian times. I can date back to the beginning of silver and gold being money, what the ratio was, and how over the centuries, how the ratio has shifted and how we got here. So maybe at the end of the video, or maybe I'll sprinkle it in while we're covering this article, I'll give a little backstory and see what happened. Because back in the day, silver was just as valuable as gold. It still should be. It's used for more things than gold is. It's an industrial metal. It's used in everything in the world technologically. Gold is used more for jewelry. So why is silver so much cheaper if it's more important? We're going to dive all into that. So stay tuned. So because of silver's dual nature, both as a precious metal and as an industrial commodity, And that's 60% of the global silver fabrication demand, jewelry, coins, bars, silverware, ETPs. It is also valid to look at the silver-copper relationship, and gold-copper occasionally also comes under scrutiny. So we have also looked at how the latter of two ratios fared during the same periods that we are looking at with respect to gold and silver, and set them against economic and financial developments to see if there's any consistency. The chart below is a simple historical view of the gold to silver ratio since the dollar came off of the gold standard. And that's a great place to start, because now we can look at what it's really doing compared to inflation and compared to an economy that's not backed by anything of real value, of intrinsic value. And that gives gold a little more time to find a neutral market price after President Nixon closed the gold window on August 15, 1971. It was at this point that two-tier system in the gold market was stopped. The London gold pool had collapsed March 1968 in the face of relentless gold demand, and at this point, the spot price came away from the previously fixed level of $35 an ounce, and a two-tier system was developed. With central banks continuing to trade at $35 an ounce, eventually this became unmanageable, especially as some banks were buying gold at the central bank fixed price, selling it in the free market and taking the profit. So the gold window was closed and the dollar started to float free from $35, and aside, the Federal Reserve still values its gold reserves at $42 an ounce. The free market price on the day window was closed. So then it averaged 59 since the start of 1972, a low of 14, peaking at 124 to 1 on March 18th, as silver crumbled to an 11-year low of $12 in the virus meltdown. So, by the way, when I said that 125 to 1 in March, that we witnessed history. Last year in March, we're going to be reading about that day in the history books. 15, 20 years from now, people are still going to be reading about the day that silver was 125 percent or 125 times less valuable than gold. That's honestly crazy, because it comes out of the ground roughly 8 to 1. 8 to 1. If you want to be in mainstream media's eyes, if you want to, I guess, give more of a public figure in the textbooks, 16 to 1, they'll say. I think the ratio is much, much lower than that, though. Coming out of the ground, by the way, not what it should be. So coming out of the ground, I think it should be around 3 or 4 to 1. So every 3 ounces of silver equals 1 ounce of gold. Why? Well, because, like I said, gold is used in jewelry, necklaces, watches, earrings. So a lot of gold is remelted. So the gold that gets dug out of the ground gets recycled around the globe. Silver that gets dug out of the ground is lost in technology. When people throw away their laptops or cell phones, it doesn't get scrapped. It's getting thrown away. So the recycling, the resurfacing amount of silver is very, very low, where gold's is very, very high, because it's profitable to pawn your jewelry or your gold earrings, because you'll get a pretty penny, because gold is valuable. It's expensive. Silver, not so much. No one's going to take time to scrap silver out of a laptop or go through the jewelry drawer and pawn or sell some silver earrings where they'll get a couple dollars for. So if you think about it on that level, yes, it comes out of the ground roughly, 10 to 1, but all the gold that's getting dig up is getting, mined is actually staying. So the ratio averaged 59 since the start of 1972. And there's an interesting thing that happened. Here, I'll sprinkle in some of the history. Back in biblical days, in ancient Egypt times, the gold to silver ratio was 2.5 to 1. It was actually, it was presented like this. 2.5 parts silver equals 1 part gold. So 2.5 to 1. They saw silver as magical. Magical. They thought silver was magic from the gods. Why? It could purify water. Silver can purify water. It has antibacterial properties. That's why it's used in these virus face masks nowadays. Silver nanoparticles, it's all very useful for killing bacteria. It also responds with other elements like no other metal does. So they thought silver was magical. It was 2.5 to 1. Then it was around 8 to 1 for a couple centuries. Then everything changed in 1930 when FDR got in office. He changed the ratio from 16 to 1, which it previously was throughout time, to 75 to 1. He single-handedly devalued silver himself. And that's where we got these crazy, crazy high prices from. So, anyways, let's keep moving on. So you could see the ratio from January 1972, and you could see the peak, right there, which we're currently at. The chart above looks at gold, silver, and copper from the start of 1990. The vertical lines highlight the periods where the gold to silver ratio changed sharply, and these can be summarized into 4 contractionary periods. 3 of these are associated with a bull market, or a gold bull market, as should be expected given silver's higher volatility compared with gold. Like I said, silver is gold on steroids. There are 2 sharply expansionary periods, both associated with the bear gold market. In between, there are 2 periods of gradual contraction and 2 gradual expansion. So what do these periods have in common, if anything? Well, the contractionary phases. Weakening dollar phase 2, 3, 4. Fed balance sheet expansion phases 3, 4. Concern over equity valuations phase 2 and 4. So there are 4 of these. We'll go from the earliest and to the last. So basically, all 3 phases have a weakening dollar in common, right? Fed's balance sheet activity, and they also have equity valuations of kilter, especially given the uncertain economic outlook. So anytime there's uncertainty going around, when there's inflation, anytime, especially like what's happening right now, silver usually comes out on top. When the economy settles down, gold is a monetary metal. Silver is an industrial and a monetary metal. And what I mean by that is silver is basically a win-win situation. Silver is a win-win situation. When the economy's in bad shape, gold and silver benefit. They flourish. When the economy's in good shape, gold doesn't benefit because it's only a safe haven metal. People only invest in a gold when times are bad. But silver still benefits when the economy's in good shape too. Why? Because it's an industrial metal. When the economy's in good shape, the markets go back open, companies are expanding, building cars, solar panels, and everything that silver is used for, the demand goes up because it's intertwined so heavily in the everyday lifestyle, in the everyday world. So whether things are going badly or goodly across the world, silver is benefiting from it. Gold, only one direction, and that's when things are going bad. So there is some correlations. No surprise that silver's relationship with gold is generally considerably stronger than with copper, and that's obvious. But I am curious when gold and silver will take on a life of their own. I don't know why the prices are so mirror-like, why they reflect each other to such a high degree when they're used for completely different things, right? Gold and silver are used for completely different things, completely different metals, completely different markets. So why do the prices look completely the same? They should look completely different. So, anyways, does this, if it is going down, to what degree, and also what would be the purpose or what would be the cause? So the technical analysis must always be fundamentals, but the same does not apply in reverse. The current structures suggest that the ratio is going lower. The fundamentals suggest that gold is going higher, and if that does come about, then silver should outperform gold in the coming months. Phase 4 to be reprised. So if gold is going higher and silver is still going to outperform it, then that could be an astronomical silver price. I mean, in August, gold hit its all-time high ever of $2,000, I think $2,090. Gold broke above $2,000 for the first time in history. Silver was only around half of that price then. Silver's all-time high is $50 in 2011, and in 1980, $50. So if gold broke through its all-time high in August last year, and silver wasn't even half of that, and silver's previous high is 50, then silver has a lot of room to run. And since silver is gold's little brother, essentially, silver follows gold, mimics gold, follows suit a couple months after. So we still haven't seen that big silver rally that we're waiting for from gold's August $2,000 journey, that rally. So there still is, there's a lot of catching up to do. What degree? Who knows? But the ratio is telling us it's going to be pretty high. I mean, the stars have aligned. The perfect storm is here. Everyone who's talking about precious metals, they're talking about silver now. They're not talking about gold. They're not talking about silver and gold. They're talking about silver. Silver was the number one asset in performing asset in 2020. Not gold. Silver was. Silver. Citibank calls for $100 silver the next year or two. Bank of America, $100+ silver in the next year or two. I think Saxo Bank even did too. All these banks, all these billionaires, all these companies, even the Silver Institute themselves, the holy grail of information, all talking about silver being the one to skyrocket. Gold will as well, but nowhere near the extent that silver is. So if you ask why silver not gold, you have your answer now. Anyone who asks that question, show them this video, because this really does explain, even from a chart perspective, right? This isn't just a theory. This isn't just an assumption. We have real patterns, real information, and we have a real strategical conclusion to look at, explaining why. So anyways, I hope you enjoyed this video. If you thought this video was educational, informational, at least entertaining, make sure to smash the like button. I post daily videos, so every single day I'm giving you guys the newest, latest information on the precious metals markets. You know, what the markets are doing behind the scenes, and also more importantly, what you should do about it. You cannot be blindly investing. You can't. There's too much going on. You need to be subscribed to at least a channel like mine that informs you on a day-to-day basis. Because imagine someone who's just at home buying silver randomly and selling it randomly. Has no idea what the prices are doing or why. Do you really think that they're going to have a successful strategy? No. That's gambling. Investors make strategic decisions. That's why you need to watch these videos, because then you can invest strategically instead of just throwing money out and hoping it sticks. Because that's gambling. That's not investing. And we invest. So anyways, I'm going to wrap this video up here. Thanks for tuning in. This was Silver Slayer. I'll see you guys soon. Peace.